Welcome to Resilience and Resolve with Lance Drury.
Welcome back to Resilience and Resolve with Attorney Lance Drury. Lance has spent more than 30 years helping individuals and small business owners resolve serious IRS tax problems. I'm Evan Mack, and today we're talking about how the IRS actually finds income and assets when someone owes back taxes, and why many people underestimate what the agency already knows. Lance, sir, welcome back. Good to see you, brother.
How are you, Evan? It's been a long time. I'm glad to be back with you.
Good to see you. Far too long. How you still doing your walks and stuff like that?
I am. So we're keeping it up. We're going.
I like it. Lance, when someone falls behind on taxes, many, people assume the IRS doesn't really know what they earn or own. In reality, what kind of financial information does the IRS already have access to?
Well, they have all kinds of access to your reported income, because people are obligated to turn in your W-2 information, which is your wages for the year. If you get a 1099, income, those people are obligated to report that to the IRS. And what invariably happens is, Evan, is that a lot of people get in trouble because they don't get their 1099, so they don't report that income. But guess what? You still have that income and you have an obligation to report it, even though you didn't get the 1099 information. And then you get audited, and then they want to tack on a big penalty. So, what we do is when people come to us and we prepare returns and they give us all their financial information, we do our due diligence. We go into the IRS systems and we check out their wage and income transcripts, which has all their reported income, because if we miss something, then our clients are going to get a penalty tacked on for not disclosing all of their income to the IRS. So we don't want that to happen. So we go the extra mile for those people, and anybody who's doing their job and preparing the returns for them should do that as well.
Employers, banks, and financial institutions all report information to the IRS in different ways. How do these reporting systems give the IRS a clearer picture of someone's income?
Well, they tell them exactly what their situation is. The banks disclose the interest information, and it's not just those institutions that you talked about, Evan. If you go gambling on the boats are going to disclose to the IRS all of your winnings. But guess what? They do not disclose your losses. So it's up to you to go back and to get a track of all of your losses on the boat, because otherwise, when you've lost money gambling, the IRS is going to count that as income if they don't keep track of your losses. It's just like your business expenses. Somebody gives you 1099 or a check or whatever and reports it to the IRS. The IRS keeps track of that, but they don't keep track of your business expenses, Evan. So you've got to have documentation for your rent, for your supplies, for your labor, all of that. Because if you don't, and this is what happens when the IRS prepares a tax return for a business, because the taxpayer hasn't filed the return, the numbers are bogus because they'll be inflated. It will show you made six figures, or you owe six figures, because they have all this income. They don't keep track of your business expenses. And so what we find out is when we file then for people, in actuality, even if they didn't make estimated tax payments, they still owe less than $10,000. So when the IRS prepares a return for you, their numbers are bogus, but they're the gospel truth until you file a return.
So what role do these documents, like these W-2s and these 1099s and other third-party reports, play when the IRS is reviewing someone's financial situation?
Well, that's how they determine how much you made in the year, because of those documents. And so those are very important documents. And, sometimes, you don't get that information. But as I said earlier, you still have an obligation to report it. It's still income to you. It's still taxable. And so you want to prevent that by going in and checking with the IRS systems, because a lot of times taxpayers are not given all of the income information that they should from the people that they've worked for or done work with.
Many people worry that the IRS can see everything instantly. In practice, how does the IRS actually gather and organize financial information during a case?
Well, the way they do it is they not only get it through their systems, but they send the taxpayer a financial statement. And, none of my taxpayers, none of my clients fill those forms out properly. They're confusing, they're complicated to the average individual. That's where you get the biggest bang for your buck and hiring my firm. There's a lot of people out there, first time the taxpayer submits it, they just go with it. Well, that's a huge mistake because they're not accurate. And you're submitting those forms under penalties of perjury. So we have to make sure that those numbers are correct. So we may go back and forth with the taxpayer 3, 4, 5 times before we would ever begin to submit those documents to the IRS because, as I've said, you're submitting those under penalties of perjury, and guess what? You give us bad numbers, we're going to give you bad advice on how to resolve your case. So we got to make sure the numbers are right. And how do we do that? Well, for certain categories of expenses, the IRS is going to require financial documentation to prove up that expense. And so we not only go through financial statements, we go through bank statements, we go through credit card statements, we go through debit card statements, we go through cash receipts because we have to prove up the number that's on the financial statement. And guess what, Evan? Sometimes the numbers don't match. Surprise, surprise. And so the IRS is going to require you to document that because whatever you put down on a piece of paper, anybody can write a number down. It doesn't mean that it's accurate. So you got to have the documentation. You have to prove to the satisfaction of the IRS that the financial states that you are sending to them are complete and accurate.
Mhm. And you work with clients who were surprised by how much the IRS already knew about their finances. Can you share a situation where the reality changed how someone approached resolving their tax problem?
Well, I had a couple people that were very surprised. I had a guy once, I call up the IRS with the financials, and they go, "We got to turn this over to a revenue officer." And the guy really didn't have enough liability to be turned over. I said, "Why do you got to do that?" He goes, "Well, you didn't give me all his rental places. He's got like 15 rental places. He's getting income from that." And of course, I talked to the guy, goes, "Well, I didn't know I had to disclose that." Well, the form says you got to put down all of your assets and all of your income. And then I had another guy, and he didn't disclose all his annuity information, and it's right on the form that you have to disclose. Well, I didn't think I had to do that. I didn't want to disclose all that. I don't want to tell him all that. Well, if you want to get a deal out of Uncle Sam, you got to disclose everything. And like I said before, you don't put everything down, that's a crime. If you're trying to get any federal benefit, and this is like getting a federal benefit if you settle for less than the full amount of the tax debt that you owe Uncle Sam, you better be fully transparent because don't hide any information. Now, if you just want to pay it all back, then you don't have to worry about any of that. But the vast majority of my clients want to pay back as little as possible to Uncle Sam. And if you're going to do that, you better be honest. You better be transparent. You better disclose every last dime that you make. You better be accurate in your expenses. And you better list every single asset that you own. In fact, now, because people weren't doing it for a while, they changed the 433F. And now they put on there, you got to disclose all your cryptocurrency because people weren't doing that for a long time. So now they've set up a specific category where that has to be disclosed to the IRS.
Hmm. When the IRS begins looking more closely at your taxpayer finances, what kind of assets are they typically trying to identify?
What kind of assets are they trying to identify? But just all of your assets.
All of them. Okay.
Yeah, and for example, let's just go through one or two. For your home, for example, they're not necessarily going to seize your home, and that doesn't happen. That's very untypical that they would do that, although they do it when that's the only asset you have and it's the only way you can satisfy the debt. But they're looking at that home, but they're also looking at the net equity in the home. And when you're in the automated collection system, the first thing they're going to do is, if you got a lot of equity, they're going to ask you to try to borrow against your home to satisfy the IRS debt. Now, it's mainly just to cover your rear end approach by the IRS because 99% of my clients, if they have tax debt, they're not going to get a loan. And the other thing is that's a problem, and they're not supposed to do this, but some of their employees don't know the rules of the game at the IRS because they're not properly trained. But if getting a loan to pay off the IRS would cause you a financial hardship, which means you couldn't pay all your living expenses, then you should not be required to even attempt to try to get a loan. It's sort of fruitless because the bank's not going to give you a loan anyway if you don't have the ability to pay all of your bills then. And so, but the IRS is requiring people to do that, even though that would throw them into a financial hardship. So that's the one biggie is the home. They want to see if there's enough equity in those homes. And that's true of other things. You know, if you've got a life insurance policy, they may want you to borrow against that if there's any cash value or anything to see if you can help pay off part of the IRS debt.
Hmm. How does the IRS use, financial information differently when deciding on collection actions compared to when they're evaluating those resolution options?
Well, I don't know that it's done any differently. You know, the biggest thing about the enforcement action is they don't even, if you've disclosed all your financial information, you set up a payment plan, then you don't have to worry about levy action or anything. But when they're just looking to levy, it's mostly because the taxpayer has ignored the notices that are coming from the IRS and it's not doing anything to attempt to resolve their information. And they're not even looking at financial information at that point. It's just that the taxpayer has a debt to the IRS. We've sent the appropriate notices. The taxpayer is ignoring us. It's not taking any steps. So then they go through the sequence of letters before they can levy. And when the last letter comes, and sometimes the taxpayer thinks, oh, they've sent me these threatening letters before, they haven't done anything, I'm going to ignore this one. Big mistake. That's why people need professional help. That's why people can't do this on their own, Evan. That's why people need my firm, our expertise, our experience, because we can help you out with the IRS.
Hmm. So, what mistakes have you seen people make when they assume the IRS won't notice certain income sources or maybe certain assets?
Well, then they get in trouble. You know, we call them up and they have all access to all of this. Most of this is a matter of public record. You know, there's not a whole lot of privacy anymore, Evan. There's all kinds of access to what people make, what assets they have, what their income is. The biggest access is the IRS doesn't have access to a lot of their expenses, and the burden's on the taxpayer to show them what their actual household expenses are. But it's a huge mistake to assume that you can hide the disclosure of a particular asset and that the IRS is not going to find out about it. Big mistake.
Hmm. And to close things out, though, Lance, for someone listening who owes the IRS and is unsure how much the agency already knows about their financial situation, what should they understand before deciding how to move forward?
Well, you got to disclose everything. The form tells you. You know, you're submitting this under penalties of perjury. Do not hide any information from the IRS. And we do have cases, Evan, where people do not want to disclose their income, their assets. And so what ends up happening is we just set them up on a payment plan where they're paying back the full amount because they don't want the IRS knowing that. Now, if you get a revenue officer, you're going to have to disclose that no matter what. And they may set you up in a monthly payment system because you have the ability to pay that based upon your income and your assets than if you were in the automated collection system. But you've got to disclose everything. That's the biggest rule. You don't want to get in trouble with Uncle Sam because it's not going to be pretty for you if you do.
Mm. Lance Drury, sir, thank you for your time.
Thank you, Evan. It's great to be back to see you again.
Good to see you too. And thank you all for listening to Resilience and Resolve with Lance Drury. IRS tax problems rarely disappear on their own, and understanding how the agency gathers financial information can help people respond more strategically instead of reaching out of fear, reacting out of fear. If you're dealing with IRS issues and want guidance on your options before the situation escalates, visit lancedrurylaw.com. Be sure to like, subscribe, and leave a review if you found today's episode helpful. Thank you so much, and we'll see you next time, guys.
Thanks for watching. Be sure to hit that like and subscribe button and leave us a review in the comments.